Welcome to the Broken Pie Chart Podcast, episode 236. I'm your host, Derek Moore. With me once again is my semi-permanent co-host, CEO of ZEGA Financial, Jay Pestrichelli. Jay, welcome back.
Thank you. And August is behind us. It's done. August is a weird month, Derek, sometimes, right? You can get the very sleepy August, or I think we've had our face ripped off once or twice in August, if you may recall, but it is now behind us.
Yay for
the good news is
yay for everybody.
Yeah. The not so good news, I was being facetious, is we're going into September, which is historically the worst month of the year on an average basis, right? If you look at the average returns for each month, Sep is always the worst one. So I'm sure we're going to see and hear a lot about how September's, historically the weakest month for the markets.
Yeah,
so you got that to look for.
That always comes out. And then, look, August was minus 1.78. People
it wasn't disastrous.
No, it was down. It was down more, and then it rallied back up. But it was, and the only reason I know that is if you go to ZEGAFinancial.com in the news, we're recording this on a Friday, September 1st. I just did an article about our hypo strategy and the trade that we had in August. So I had to pull that number, and I'm like, okay. But I want to talk first about this. Jeff Weiniger on Twitter had posted a screenshot of, it's basically Wells Fargo, Chase, and it's the interest rate, the APR you could get. So this must be, it says offers from banks you may use. And this must be from bank rate. So Wells Fargo will give you 0.15%, Chase 0.01%, and Bank of America 0.01% APR on your savings. By the way, Jay, I will tell you, you don't get that, let's say with Chase or Wells Fargo, unless you have $25. So if you want the 0.01%, Jay, you need $25 in that account.
I have a Chase account. I'm like, I'm slapping myself. Like, why am I making nothing on my Chase account? Like, at some point, this has to transition, right? We've had interest rates above zero for well over a year at this point, right? Year and a half, even above like 2, right? Like, why am I still leaving my cash over at Chase and Wells Fargo? Can you I should fire myself. Can I fire myself?
Maybe so.
I need an advisor.
Well,
you looking for clients, Eric?
We'll talk afterwards. I would say, though,
how is this the case? Like, why is this the case? It's not supposed to work this way, right?
I remember. Okay, there's two things. Number one is I remember in the mid '90s, most brokerage accounts would not sweep to the bank side; they would sweep into a money market fund. So, back then when rates were 5%, you were getting roughly that. And I remember bank rates were. This is savings. This isn't checking either. So
that's even worse. I didn't pick that up. Savings, great savings rate, everybody.
Yeah,
thank you.
I think you're right, though. At some point, now there is, what do they call that? The barriers to switch. So if you have to switch, that's paperwork, and I think a lot of people these days have direct deposit, or they have, your payments set up. But I don't know. I think a lot of people are going to wake up to this if they haven't already and say, "Why don't I just go?"
It's not like it's hard to move money between accounts anymore, right?
No,
like with things like Zelle and Venmo and the ACHs, it's like you could move money in 2 days if you had to, right?
I know.
So it almost seems ridiculous. I've always been a proponent to leave a couple months of your expected bills in your checking account, right? You should have 2 or 3 months of your cash out in your account, and the rest you should invest. But really, I'd feel really embarrassed that I have money sitting there at Chase at a 0.01.
Yeah, maybe you should book an appointment with me. We'll go through that. Maybe the other appointment that we see on the verge of happening is actually, that's a horrible transition. I'm just going to avoid it. I'm just going to drop it. Jay, Econ PI, we watch that from time to time, econpi.com. You like my little transition there? This is
terrible.
Yeah, it was awful. If we actually edited the show, we'd edit that. We don't do that. So Econ PI, what it does is I'll put a link in the show notes. It puts things into a quadrant, and things are either in expansion, recovery, contraction, decline. So you think about that wheel or the normal process, and they have the median of coordinates. Those have moved to the decline quad. They've been there for several weeks. Jay, the audience can't see this, but I have last Friday, the graph, and then I have today. And, stuff moves in and out. But I will say over the past month or so, more things have been in the contraction quad. It doesn't mean a recession's imminent, but is this anything, Jay?
Okay, so there are a lot more data points in the declining quad, and they have moved into the contraction quad, right? So that nothing's really, the ones that were in the expansion and the recovery are still there. The middle point hasn't moved very much, but you're right. So, do we think that maybe the economy has still got some slowing down to go because of higher rates, and it's just taking longer for the ripple effect to occur? Maybe. I don't. I'm still in the camp of I'm not sure why we think we're going to have a recession at this point. So I don't know if the contraction quad equals recession. I think it does, but I would say, yes, while things are moving in there, I'm still not convinced that is an inevitability.
Has sentiment switched, Jay? Where, before it was like, 98% of people, I'm making that number up, but it felt like it if you watch CNBC, said a recession was imminent. They said at the end of 22, then they said early 23, then it was pushed to late. Now it's 24. Like, I feel like the recession will come when everyone says it's not coming.
Yeah. Well, of course, right? And of course, that's why it didn't come when everybody said it would come. We've talked about this before, right? Mm-hmm. 27 out of 28 economists surveyed at the beginning of the year said there was going to be a recession in their documentation or their projections. So, yeah, so you're right. That's always the way that it goes. And look, we will eventually have a recession. Like, nobody's saying we're never going to have a recession again, right? But look, we're in August. Through August, September. I just was happy to be in September. We're in September now, and it still doesn't, appear like it's rearing its head. Like, I don't, at some point we will, of course, we always do. It's natural, it's healthy, right? But it doesn't feel like it's around the corner, Derek. And you may be right. As soon as 27 out of 28 don't think there is a recession, that's probably when it happens. When you get the all clear sign. I wasn't sure where you're going to go with the sentiment conversation, because that's a longer sentiment trend that you're talking about here, that there's a change now that, maybe 50-50 that I see on interviews on Bloomberg or CNBC are mentioning recession. So I guess that longer term sentiment is there, that it's changing, meaning sentiment of less chance of recession. But I thought you were going to go down the path of, like that the AI wave is kind of just diffusing a little bit, right? A quarter ago, everything was AI, right? NVIDIA saved the markets in July, and in their or June, whenever their earnings were. And then their earnings this month, while they still had incredible numbers and they still beat the whisper number, it still didn't cause that broad, lift in the tech sector, right? I mean, it was certainly well received in the stock and it hit a new high, but it wasn't like if AI is even in your name, you're all of a sudden going to go up 20%. That seems to have faded a little bit, because I really do think NVIDIA changed, 3 months ago, changed the dynamic of what was going on in the equity markets, certainly in the tech markets. But that might have fizzled a little bit. So I thought you were going to say, has sentiment cooled a little from how hot it was in June and July? I would say yes, it has from there, but definitely still better than January.
I agree. So I think we should talk about the employment numbers that came out. Later on, we're going to talk about option synthetics, and we're going to talk about volatility. So you and I always talk about volatility. First,
get your pillows out. I'm kidding.
I think these days a lot of the audience is like, no, talk about option synthetics now. So
No. We think it's amazing. I joke because I would talk all day about synthetics and volatility. But
yes, well, yes. All right, let me get to the employment picture. A bunch of us on the investment committee and trading, we were sort of messaging this morning when the numbers came out. And immediately when I saw, and CNBC, I think, mentioned unemployment ticked up. So there's a couple maybe anomalies, maybe not. But let me just throw some numbers out at you. About 37% or 37,000 trucking jobs were lost. You might remember Yellow Trucking. I think they went out of business.
They were yellow with the orange logo. Yes.
Yellow with the orange logo. Yeah, that must have been a marketing meeting to be at. So, and then about 17,000 motion picture jobs. And then I have a question mark here because I think I saw, I went to the state of Hawaii database, and everything that's gone on there with the fires in Maui and Lahaina, which has been just awful stuff.
Awful.
But I did read that something like 8,000 unemployment claims were filed, which unfortunately makes sense. So I bring this up because the trucking was sort of a business closing, and the BLS even mentioned that it's sort of a one-time business close, and then the strike in Hollywood, and then as long as things go on, you're like, all right, I had these people on staff. So I don't know, so unemployment, I'm going to take you through this and let's get into the discussion. 3.8% is the unemployment rate. Last month, it was 3.5%. So it ticked up 0.3.
It feels like a pretty big move, right? I mean, it's been kind of stuck in that 3.4 for a while, right? So it felt like that number felt like a big move to me. How'd you feel when you saw it?
Well, I know too much. How's that? I know.
You are correct, Professor. It's always your problem.
No, because it goes into how the numbers are calculated. And one of the things we notice is the labor force participation rate. So, all right, let me just, we have the population, civilian, non-institutional population. That means people who are of working age, I think that's 16 and over, and who are not institutionalized. I think mainly they mean in prison. The civilian labor force then is everyone who is working or looking for a job. It doesn't mean you have to be employed. And so basically what you do is you take the civilian labor force divided by the civilian non-institutional population, and you get the labor force participation rate. Most recently it was 62.8. Okay. So what's interesting is if I look at the number of people employed, 222,000 people more were employed in August than were in July. And you're like, how the heck did the unemployment rate go from 3.5 to 3.8? Okay. So what happens? Well, more people came into the civilian labor force. And of those people, there were 514,000 that were unemployed. I said 222,000 that were employed. So what you have here is the labor force grew, and it's just math. You take the number of unemployed persons, which did go up, and you divide that. Now, let me just simplify this for a second. Let's say you get a guy who you know, and he gets a call. This is the household survey. So these are not businesses being called. That's the establishment. This is the household. Gets a call at his home, and they say, hey, are you working? No. Are you looking for a job? No. Okay. That person is not in the labor force. They're not considered unemployed. They're part of different metrics that are also published. Same guy gets the call a month later. Are you unemployed? Yeah, I still am. Are you looking for work? Oh, yeah, I am. That person is now unemployed and in the labor force. All right, Jay. That's a little econ 101 there of how this stuff works.
No, that's good because, right, it's the numbers that are moving around. So even though there were more people working, the unemployment rate clicked up because of the population change in the math, right?
That's right. Population change and people who have either previously were unemployed and not looking for work and started to, because they go from not in the labor force to in the labor force. And it also, and you think about it, how does the population change? Okay, people get older, younger people change into the working age. You could have people immigrating to the country, people leaving the country. So there's any number of things that are in there. But yeah, Jay, I think when I look at this and those numbers I gave you, the one-time trucking thing, and by the way, it's one time because you hopefully assume those folks find other employment. You have the Hollywood thing, you have the horrible thing in Maui. So I don't know. I think this could be a little bit of an anomaly, but let's watch it. But certainly the labor force participation rate being the highest since 2002. That's 25 to 54, the prime sort of labor years. That's pretty significant, Jay. Let me step back. I want your thoughts here.
Yeah, let's think about what does that really mean, though, right? So the so more people 25 to 54 are at working, right? Is that the participation? Not that they're in the labor force, obviously in the labor force because of their age, but now more are working. Does this mean, less people are sitting around waiting for their ideal job, right? Is that how we interpret this?
I think it's both, Jay. It's they're either working or they've decided to look for work actively. Because
that's participation is actively looking. Got it. What is the legal working age? Do you know? Like, what's the cutoff? 16, 18, 15?
I believe it's 16. Yeah. I believe it's 16.
So could it be that just a bunch of people had birthdays in August? I'm just kidding. I'm joking.
We're going to have to run a regression on that. By the way, I will tell you, speaking of younger workers, what do younger workers get? They get a summer job. Now, these are seasonally adjusted numbers, so that's sort of baked in there. But it is interesting, 19,000 temporary help workers that came off the books. So less temporary work. But I don't know, Jay. I mean, do you think this has any implication? I think the bigger picture here, too, is like the market actually liked this. Isn't that crazy? They're like, oh, unemployment ticked up. Awesome. Interest rate expectations go down.
Yeah, maybe. So then it all leads to interest rates, right? Maybe the Fed can stop trying to, maybe the Fed's done enough, right? That's the way I always interpret it whenever bad news is good news. There was another data point that I think was pretty well received in all of this, and that was actually hourly earnings. Hourly earnings were expected to go up 0.3%. They only went up 0.2. Previous month, they went up 0.4. So hourly earnings, kind of a quasi, inflation data point, not quasi, I mean, it really is an inflation data point. So that looks to be less hot than expected and than the previous month as well, right? I think the market likes that data point more than any of this, but up for debate on what moves the market up and down right when those numbers come out.
Jay, don't you think that Jay Powell and his compatriots on the Federal Reserve Board, a wage spiral, meaning a spiraling up of wages, that sort of is what keeps them up at night, right? I mean, they worry about that.
Yeah, because that doesn't get unwound, right? Like, food prices, gas prices, that stuff changes, right? Interest rates on, the cost of a mortgage, that stuff could change. But wages, like, that's pretty sticky. Like, most people don't have their pay changed month by month or year by year. And typically, maybe it doesn't go up as much, but it usually goes up. And when people switch jobs, we already know this from a different podcast. I can't remember how long ago we covered this one, that when people switch jobs, it's there's usually a pay increase associated with it, right? So as we were watching wages go up, it was the job switchers had a bigger increase. And so, that's why I think that to me is the stickiest of inflation data points and absolutely is the thing that keeps the Fed governors awake at night.
All right, Jay, this is one of those while you were sleeping moments for crude oil. Oil futures, they broke out, and you and I are both technical or technicians at heart. A little bit of a cup with a handle pattern. Oil today, did it break 87 at the close? I'd have to look. But this is the highest level since I think November of 22. We're not necessarily talking about inflation today, but oil is one of the components of the CPI, not the core, because they removed food and energy. Is this breaking out when no one was looking? Like, it's kind of interesting.
Yeah, and it kind of snuck up on us, right? So just as recently as a week ago, this was not even kind of sniffing a breakout, and then it's been on an interesting run. I don't know if some of it had to do with the hurricane, and I know you'll touch on inventories in a second, but if right, a cup and handle is a bullish pattern where there is like a long, there's a top and then kind of a big kind of valley curve, and it gets back up to the previous high and then a little dip and then a recovery. And then that typically then could turn into a much more bullish move after that once it breaks above the rim of the cup. And so, if you could think about that, that one's a fun one to look up on Investopedia. But yeah, I mean, if oil goes, it definitely could be, it could be on the top line. It's not a core piece, but oil has a ripple effect, of course, across everything when it comes to inflation. Yeah. So might be a very interesting little breakout here. Nobody's really talking about it yet.
No, well, that's the type of analysis you get here on the program, Jay. As always, first to bring you the container shipping situation, and neither of us are experts, obviously, in the oil market. And I'll remind the audience, anything we talk about here, I mean, really, our core philosophy is to buy but be hedged, and so don't take anything we say for trading ideas. Jay, you did tease the inventory count. It's no secret that the government has been draining, let's say, the Strategic Petroleum Reserve, the SPR. And if you look at a chart of inventories, which includes the SPR, I think we made a new low recently. I don't know what the as of date. I got this from JP Morgan's Guide to the Markets. What is this? Million barrels. So yeah, what do we go from 13 billion to 800?
Just under 800 million.
That's kind of significant. And there's two things to look at this.
Yeah.
I mean, the SPR can compete with markets, but normally the SPR is not really doing anything. It's just storing oil. So it's sort of like maybe the market is looking at this and saying they've dumped all the oil they can. They don't think they're going to dump anymore. And it could be demand is starting to come up. I don't know, Jay. We'll know when we know on this, right?
Yeah, I mean, this is another thing that the concept is that you release oil right from the strategic reserve, and then you fill it back up, which means you got to go back into the market and buy it, right? So when you release, you should increase supply, pushing prices down, and vice versa. Doesn't look like it's been refilled, right? So just going back. This was approved to have to draw down the SPR because of the Russian war in the Ukraine and the pressure that it put on oil. So, that is one of those things that it looks like the market has kind of evened itself out a little bit from that. What are we, a year and a half into that conflict? And oil shot up going into that conflict, and then it dropped. But you're right; it's kind of on the way up again here. So. Yeah, like to backfill that is going to be again a constraint on supply if they were going to kind of refill it. There are a lot smarter people than us about the Strategic Petroleum Reserve, right? So we could leave it to them, but it's an interesting data point.
It will help earnings. Let's transition to earnings, and we basically have all of Q2 wrapped up, except I think 3 companies. I don't know who they are that haven't reported, but everyone majors reported. And I mean, coming into Q2, I think the street estimate, Jay, wasn't it minus 9% year over year? I think it was that high, right?
Oh yeah, no, yeah. It was expected to be a pretty abysmal quarter.
What did we wind up at?
Yeah. We came in at a minus 2.9 for the quarter.
Not too bad. Not too bad. So
not nearly as bad as previously rumored, right?
And I think last quarter too. Well, Jay, I mean, last quarter too, you talked about this 0.1% for Q1. Wasn't that supposed to be -5? So they haven't been as bad. But the outlook, Jay, is looking good. Take us through the outlook going forward and maybe talk a little bit about how those change over time.
Yeah, so Q3 is projected to be a positive 1.8%, which would be the most going all the way back until Q3 of 2022. So that's nice to see that would be we'd be on the rise again. But Q4 is where it gets really interesting. It's a projected positive 10.6%. So I mean that's a real change, right? Coming off the bottom there. Maybe as a reminder, so the last three quarters, Q4 of 2022 is a minus 3.2. Q1 of 2023 was flat. It was a plus 0.1. And then we just put in a minus 2.9. Now we're projected for a 1.8. However, that plus 1.8 has been coming down over time, right? So if you look at the beginning of the year, the Q3 projection that I just said that we're projected to be a plus 1.8 was plus 5.5. And even before that, the quarter before that in October, when the market was really having some trouble, it was projected at a plus 9.2. So, and it has been kind of ticking down little by little, right? So, like I said, beginning of the year, we were projected to be 5.5. In April, we were projected to be at 2.8. And in July, we were projected to actually be at 1.3. So it's at a slight tick up, but it looks like it's kind of leveling out here, from April, July, and now we've been hovering around the two range. I guess we'll start to see. I mean, we're in Q3, Derek, right? Like we're 2/3 of the way done with Q3. We'll obviously get the data, once we're done with it. But, this has been an interesting trend here that has been coming down. I will say if you go farther out, like through 2024, which we just talked about, folks have been projecting a recession in 2024. The exact opposite in earnings seems to be the case. I just mentioned 10% for Q4 of 23, but Q1 of 24, plus 9. Q2 of 24, plus 12. Q3 of 24, plus 13. Q4 of 24, plus 13. So there are a lot of, look, I don't know if that's the default. 12 and 13 is the default for the growth rate. But, there certainly down the road looks to be a lot of positive earnings improvement.
I think over time, we tend to see analysts start high and then the analyst expectations come back in, meaning they go down. It was a little bit unusual when we saw after 2020 when estimates were really low and they had to start raising them. But yeah, we'll see. And I mean, the market was. Think about this: we really didn't get a negative quarter year over year on a quarterly basis until this year, but yet the market sort of anticipated that. Well, I guess Q4 of 22, but the market was down from January until what was that, September, October, and then has rallied. So it tends to be forward looking. Volatility, though, Jay, is sort of another thing that's maybe forward looking, maybe it's just reactionary. But I'm sure, as I was going to joke around and say, did you see what happened in volatility today? Of course you do. Is this the lowest we've been in some time, right? I mean, volatility's been getting crushed last week or so.
Yeah, I mean, we always measure volatility as with the VIX, right? That's kind of one of the main metrics that we look at, and we are right near that bottom that we've seen for this year. So you are right, Derek. Today was one of the lowest closes of the year. There was one other close that was a little lower. Looks like back on June 22nd. The VIX closed at, let me get this number here, 12.91. Today we closed at 13.09. So fairly close, but it has been like a very steep march lower, right? When you look at the last 1, 2, 3, 4, 5, 6, 7 days coming off of 17, it's been straight down to this 13 level. So vol is definitely coming out of the market. So what does vol mean, right? I know we've gone over this, and I always feel like I'm preaching a little bit. This number, the implied volatility of the options market, is driven by what people are paying for calls and puts, meaning the premium, the extra that they're paying, or how much more they're willing to pay for options. A lot of people call this the fear index. We do not. It's more of a speculator index, right? Because you can have a VIX pop higher because of call premiums popping, not just put premiums popping. So, but the underlying idea is that when the market's about to get pretty volatile in a day-to-day move, option investors and speculators are willing to pay more because they think the payout will be greater and greater moves are coming. So again, it's why we call it the speculator. Speculator doesn't always mean up, right? It just means speculative move either way. And that has really been sucked out of the market here. I'll also throw in before you comment that the volatility of the VIX itself, how much people are willing to pay for VIX options, is also on the lower end. It dropped below 80 this week, finished out at 82. That's also a sign that says even the volatility bettors that bet volatility directly aren't willing to pay up for much. So that tells us that the drop in volatility may be here to stay for a little while if you're to read the tea leaves like that. So sorry, Derek, went off on volatility a little bit, but it's one of our favorite topics.
It is, absolutely. I'll just say, I think you pretty well covered it. Volatility, in my experience, and I think in yours as well, it sort of takes the elevator up and the stairs down. I don't know what I'm talking about, but it tends to rise very quickly, but it doesn't come down. We saw that in 2008, 2009. You had this elevated volatility regime for a while. And we still, even as markets were making new all-time highs, volatility was still pretty high considering we were at an all-time high, just in, what was that, the end of 21. And so this may be the sort of this long-term process of finally getting back to a little more equilibrium. It also could be maybe there's not as much fear of a recession or of the Fed just really doing a Volcker type rate raise. I don't know. I think it's just interesting, and it's really come out recently, and it's no coincidence, I think, that it came out after earnings. Everyone was worried about earnings. Earnings turned out okay, and profit margins turned out okay. I don't know what's going to happen next week or 2 months from now, but yeah, Jay. All right.
Yeah, listen, I will make one last comment. You and I have studied volatility for a long, long time. There is a statistical relevance when the VIX closes below 13. If you look at the history of the markets after that, I think, Derek, if people wanted to learn more about that, could they contact you? How would they get in touch with you?
Yeah, well, they would shoot me an email at derek.moore@zegafinancial.com. That's Z as in zebra, E as in Eddie, G as in George, A as in April. Financial's up to you or anyone to spell correctly. But yeah, absolutely, Jay.
That was it. That was my throw to you on that one, Derek.
No, I like the throw. Let me set up the next segment here. Are we doing segments now? Maybe not. By the way, you and I have a hard stop. That's why normally we're sort of a little looser with the schedule, but we've got a hard stop, so we got to cut off the recording at some point. Jay, a lot of talk about option synthetics, and when you hear the word synthetic, sometimes you think about artificial turf, that awful stuff in the 70s and 80s that people played at. By the way, Jay, I played on that stuff. I played baseball and I played soccer on it. No picnic playing soccer on that, the old AstroTurf. Baseball was, just really bad. But when you think about synthetic, it matches something else. And so when we think about if you were to buy a stock, say $100 stock, the worst that can happen is the stock goes down to zero, assuming you're not on margin or anything. Let's set that aside. Buy 100 shares at 100 and go to zero, you lose all your money. If you sell a put option, well, you have the risk to zero minus whatever premium you took in. And if you simultaneously buy a call and sell a put, well, you have unlimited upside and downside to zero plus or minus whatever premium it is. So when we think about being synthetically long, Jay, that there is that structure, that sell a put, buy a call, that you experience or take on the same risk reward profile, plus or minus. So I don't know. I mean, it seems like this has been more and more in the news lately, and people are using options a lot more now, and it's the computer systems and everything like that. But Jay, kind of take us through a little bit of synthetics, and I kind of couched it there. I didn't steal too much of your stuff, I don't think, but
No, no. Look, synthetics are definitely an option tactic that we use. As you said, it mirrors a long position. You normally don't earn dividends, right? Maybe the options may reflect some of the dividends, but you don't get paid dividends, right? That's one of the major differences of being long stock or being long a synthetic. Think about synthetic as just, the way options can replicate stock exposure, right? But you could do it in a much more cost efficient way. What do I mean by that? So, right in your example of $100 stock, if you were to buy 100 shares, it's costing you $10,000, right? 100 times 100. But if you synthetically created exposure to that stock, if let's say the call was trading at $7 and the put was trading at, $5, I'm deliberately making them not equal. It would only actually cost you $2 a share to get long that $100 stock. So you could only spend a $200 debit to make it feel like you spent $10,000. Now, the moves of that stock are going to be the same, right? So a 1% move when you own, $10,000 worth of a stock. I'm going to use 2%. A 2% move when you own a $10,000 stock is $200 plus or minus. That will still happen with your synthetic. You will gain or lose the $200 each day, but it didn't cost you a lot to get into the position. And so it's a much more cash efficient position. Now, it doesn't mean you get that for free and you've got all this extra money. There is a requirement because the options world knows that, hey, the stock could go to zero. You have what's known as usually we use Regulation T option requirements. Not to get into that, but you need you need to have something like 25% of the strike price of cash or some sort of collateral to do that. So while it's not, free money to do it, it's a more efficient way to do it. And these days with vehicles like treasuries that can be used as collateral, you can use treasuries as your collateral, earn your, Fed funds rate is 5.25. You could earn that and then also have exposure to the stock. And so this is one of the tools that when rates are where they are, we like to use synthetics as a more efficient way of getting long a particular holding. And you could do things like sell calls as if you would like a covered call, or you could create, if you wanted, a little leverage without borrowing, right? You can, instead of buying one contract, you buy two contracts. Doesn't cost you anything for margin, but you could kind of double your exposure. So very easy to create, excess exposure if you want. Or even in like IRAs where you can't use margin, you could do things like use synthetics. They take up less buying power, and then you could do, use that buying power to do other things, in your portfolio. So it allows you. It's just a tool to allow you to do more with less. And there are definitely some pluses and minuses when it comes to synthetics. The biggest minus is that options expire. So if you use them in a taxable account, you will have a taxable event one way or another at expiration, right? So it's just one of those things that use it appropriately. We like I said, we use these all the time. Even for collars, we could collar up with these things, right? Buy a put, sell the call, and you've done a good job of managing your risk, and you've done a good job of managing your cash usage. So it's a very, it's not popular. It's scary. We say the word synthetic, and people like shy away, like, oh, I don't know, that sounds complicated. But as Derek said, it's just as simple as buying a call and selling a put at the strike price, and you will get the same effect as if you were long the stock.
I think follow on a couple of things that you said. One is we're not advocating taking any sort of leverage. So when you think about one versus another, and you didn't necessarily say that, Jay. I just like to couch it, right? I'm not.
I think it's good you do say that, though. It has to be appropriate, right?
It has to be appropriate.
Right for you.
Like the way to look at this in your example or my example, it's sort of our example now. 100 shares of stock at $100, you're spending $10,000. If it has a dividend, you get a dividend. If it doesn't, well, obviously there's no dividend. But in your example, Jay, where buying a call selling a put, and you buy one at, would you say 7, the other one at you take in 5, so you're spending $200. That $200 controls but doesn't own 100 shares. But you still have all of that downside that you did, even if you had the stock. So I think it's an important point to make that it would be easy for someone, in maybe just learning about options and thinking, oh, this is great. I can control, 100 shares of stock for $200 here. And you pointed out, yeah, there'll be some requirements from the different brokerage firms. But I think the way I look at a synthetic is, if I want to have the leverage or the exposure of 100 shares, I could do this other structure, still have the same exposure. And as you pointed out, Jay, with treasuries being, 5.5 now on the short end, that gets kind of interesting. You mentioned collars too. And maybe I don't know, should we talk about? Yeah, let's talk about that. So let's follow up on that a little bit. So same stock, Jay, $100 stock, XYZ. XYZ, by the way, is my favorite symbol, my fake symbol, compared to ABC, which is my second favorite fake symbol that we use. But XYZ is $100. So let's say if you wanted to limit the downside, but at the same time, you're willing to put a cap on it, to take us through a structure.
Yeah, so you just said it, right? So collars are designed to limit risk, and you are going to try to fund that protection by giving up some of the upside. So let's say you're in a position and you don't want to lose more than 10%. That seems to be a nice round number on $100 stock. You would do something like buy the 90 puts. That 90 put may cost you a couple dollars. Let's just say $3, 3% around hedging typically can cost that for large caps. It could be more for more volatile, but let's just say, this stock is not so volatile. You pay $3 for that put. Well, in order to pay for that $3 so that you don't lag your stock's movement, XYZ, by $3, you could then maybe sell an out of the money call, sell the 110, sell 10% up and get $3 for that. And that's what we call a zero cost collar. And in that scenario, you've got protection, you've limited your downside risk, you've capped the upside, but you've used that cap that's selling the call for $3 to pay for that protection. And so the protection doesn't cost you anything. It doesn't cause a drag. Yes, you may not participate in the market appreciation if it goes up more than 10%, but you've also limited your risk. And so if you're using a synthetic and then you're also collaring it up, it's a really efficient way to create a position that's both protected and leaves you plenty of cash available to do things, to make other investments. And so, if you only, in that scenario, you only have a 10% risk, then you could then turn around and say, okay, yep, I didn't have to spend all of my account on this $100 stock. I only had to, I know my max risk is 10%, put that aside. I still have 90% of my account that I could use for something else. And you could put on multiple positions, all collared, that you've defined your risk. Now, of course, you're also creating implied leverage and notional stuff. There's more complication there, but it's just a way to protect yourself with not a lot of cost. Hedging is very important for us at ZEGA, as Derek has mentioned multiple times. We like to say that the only thing you really can control when you invest is the risk you take. And by using options, you can define what that risk looks like. In that example I just gave you, 10% risk on a position if I buy a put and have it or funded by selling a call.
I will mention, by the way, before we get to our recommendations, it is coming up on Labor Day, 3-day weekend. Well, by the time you listen to this, it'll be Sunday. But Jay, what better time to pick up a copy of Buy and Hedge, your book on published? When was that published?
It was 2011, I believe.
With a reprint. You did a reprint, right? So Buy and Hedge. I did
do a reprint. My publisher, believe it or not, one of the biggest publishers just decided to get out of the book business because everybody was doing it independently. It's a very interesting dynamic. I'm glad we aren't in the book printing business, Derek.
Yeah. Well, as far as I know, so my publisher, they had operations in the U.S., but they had a big operation in the U.K. So Broken Pie Chart. I always like to pair Buy and Hedge with Broken Pie Chart, available on Amazon as well.
They are a good fit together.
Yeah.
It's a nice pairing.
Very nice. And we ever write a book together, Jay, which someday may happen, we'll publish that. We'll let everybody know. All right, Jay, real quick, some recommendations. I think I know where you're going, and I'm going to let you do it.
All right. Well, I mean, love to talk more about synthetics, but we've gone on. We should talk about shorts next time, Darren. Maybe that'll be an interesting idea. So my recommendation is, and I've been very happy with it so far. It's been week 3. If you're a Star Wars fan, I'm definitely enjoying the Ahsoka on Disney Plus Star Wars series. It has been actually pretty great. If you're a Star Wars fan, I think they've been doing a really great job about it. Most people aren't familiar with that storyline, right? Everybody gets the movie storyline, the Skywalker storyline. This is kind of independent of that, kind of like how The Mandalorian was. It's very similar. Definitely enjoying that one. That is my strong recommendation.
Are you pounding the table
Star Wars people?
You pounding the table
for a Star Wars person?
Yeah,
absolutely.
Okay,
absolutely.
All right. I haven't seen it.
Look, it's no Rogue One. It's no Rogue One. Like, you and I love that movie, but it's up there.
Yeah, that's the best. And I don't want to ruin it because I don't want to even talk about the final scene. But if you haven't seen Rogue One, you should see that. I will mention got through Breaking Bad. Took me a long time, but it definitely recovered. Like the middle seasons, I felt like were a little slow, but the payoff at the end, I give it a strong recommendation. It's a strong buy on Breaking Bad.
Wow. Okay. Yeah. All right. And I know Bill helped you get back on that wagon, didn't he?
He did. Yeah. No, Bill is like, no, you got to stick with it. Friend of the program, Bill, and John as well. But yeah, I mean, and then what I found too is there's a sequel. There you go, called El Camino that actually picks up from the last episode, and it's just a movie, which, by the way, I enjoy. It's like, okay, I can watch this for 2 hours, and so that's on my list. I'll report back. Bill also mentioned he wanted us to throw in Kaleidoscope. I think it's on Netflix. Might be on Netflix. About bank robberies. So the audience is giving recommendations now. And
wow, that's great.
Yeah, no. And then Secret Invasion, I think it's on Hulu with Samuel Jackson. That's from our friend Michael. He recommended that one as well. So that's what people are doing these days. They're giving us recommendations to point out, Jay.
Okay, great. Put them out there.
All right. Well, I think we'll call it here. Hopefully everyone has had a good holiday weekend. Maybe next week we'll talk about reverse ratio gamma scalping or something like that. I'm sure everyone will be back for that.
That's a good one. Let's bring up gamma scalping.
No, we're not talking about that. All right, Jay. Have a good one. We'll talk to you soon.
Thank you, Darren.
Take care.